Now, I'm a very competitive person. I might not show that on these videos, but if you set a goal in front of me, I'm going to do everything I can to achieve that. And I also like to watch sports and boxing and MMA because it's competitive, it's fun, it's exciting. And I think we just recreated in the investing world what happened with the Super Bowl, where the underdogs came in and had a blowout against the Chiefs. So in the investing world, there has been an ETF that has been dominant for a long time. It is the biggest ETF, or was until February 18th, just a few days ago, and that is SPY. The ticker symbol is SPY, that's the ETF, and it got dethroned by VOO, VOO. Now, officially, VOO is now the largest ETF in the world, and you'll see here on this chart that it kind of started back in 2011 when it went on the market, and it slowly has cut up over time and now has become the biggest ETF. Now, this is over decades, so I want to put this in a different perspective for you. If we look at the last 5 years, VOO is up 83.91%. So remember that number, 83.91, where SPY is up 83.8%. So very minimal difference. They're both investing in the S&P 500 index, so they have similar top 10 holdings. In fact, they have the exact same top 10 holdings, we'll see in a minute, but with slightly different weights to those companies. And they have some other differences, which I think has contributed to VOO becoming the largest ETF. So if we look at the top 10 for SPY, we have Apple, Nvidia, Microsoft, Amazon, Meta, Google, Broadcom, Tesla, Berkshire, and you'll see the weight there on the right. Now, if we look at VOO, exact same companies, but just with some different weightings. So to put this in a very easy to see format, I created this quickly. You have the ticker symbol on the left. We're going to go off of VOO's order because if you look at SPY, Nvidia, the third one down, should actually be its second top holding. But what I did is I'm going to show you in the last column the slight difference between these two ETFs. So VOO has slightly less Apple, which I personally like. Microsoft, they hold a little bit more, and I think Microsoft is a great company, so I like to see that. They hold slightly less Nvidia, which I think Nvidia has some overvaluation going on, and so this is good. Amazon, they hold more, 0.26%, and I am really bullish on Amazon. It's one I hold in my portfolio, as well as Microsoft. They have slightly less Meta, but I actually think SPY is better off here because Meta's been doing really well. They have slightly more Google, which I think is great because I think Google is undervalued, has more upside potential. VOO has slightly more Tesla, which I think Tesla is another overvalued company, so I actually prefer SPY's allocation. And then you have Broadcom with VOO having slightly less, which I think is fine. And then you have Google. Now there's two Googles because there's Class A and Class C shares, but basically both holdings, they have more Google, which I really like. And then Berkshire, they have slightly less, which I do like as well, because I think Berkshire is just that solid company that's not going to really outperform like the rest of these companies on this list. So why did VOO take over SPY? I think there's one main reason, and that's the expense ratio, that fee that they charge investors for investing in their fund. It adjusts your net asset value. So VOO has an expense ratio of 0.03%, where SPY's is 0.09%. Both are very small, but SPY's is 3 times more, and that does make a difference long term in your performance, in your returns, in your profit and growth. And so I think that's why there's more attraction towards VOO, why it caught up so fast. And that's just, if I'm looking at an ETF and they're very similar, like S&P 500 funds that they follow, I'm going to choose the one that has the less expense ratio. Of course, you look at other things, but that's a big part of it. Now, VOO's assets under management surpassed SPY's due to $2.8 billion in outflows from SPY and $305 million of inflows into VOO. So more people are choosing to sell SPY and buy into VOO recently, which is very interesting. Now, VOO did set the record in 2024 for net inflows for a single ETF with $116 billion. That's massive. And SPY was actually the very first US listed ETF when it launched 32 years ago. So it's the original dog. It's been around forever, and it's still been a great performer. It's just VOO came in with that lower expense ratio, which I think attracted more investors. Now, just for fun, the third biggest US ETF by assets is the iShares Core S&P 500 ETF IVV. I've never looked into this one. There's a lot of S&P 500 ETFs in there. I hold one in my portfolio that has not been mentioned yet, which you'll see in a little bit. But just a little bit more background on VOO. There's a guy by the name of John. He's a legendary American investor and entrepreneur, and he was the founder and chief executive of the Vanguard Group and is credited with popularizing the index fund. And he once said, "Don't look for the needle in the haystack, just buy the haystack." I really like this saying because a lot of people try to go out and find those individual companies that they think will outperform the S&P 500, but that is something that not many can achieve. And I won't say it's a needle in a haystack because I think you can find companies. I have a process how I find my needle in the haystack companies, which I'm going to share with you in a minute. But I think it's more so you just have to do your due diligence, your analysis, and you can find those companies more easily than a needle in a haystack. But really what he's saying is instead of worrying about, trying to find those outperformers and having a lot of risk with that, you can just buy the S&P 500 in one fund and still have excellent performance and beat out most investors that are choosing to pick individual companies. Now, ETFs have become wildly popular, offering retail and institutional investors the ability to invest in hundreds of America's largest and most innovative companies through one clean, tradable security. It is very easy. It's painless. You don't spend a lot of time. You just let the fund manage itself. You just sit back and relax. In fact, you forget about it. You just put it on reoccurring purchases of that ETF. And I will say this, to invest in an ETF is not weak. A lot of people out there like to make fun of people that just do ETF investing. And I think that is not right. I think that a lot of people are very smart to do this because you're the one that's setting aside your ego and acknowledging that very few can pick individual winners that outperform the S&P 500. And now you have a lot of people out there that claim they do, but they don't really provide the backup for it. I do, and I came out with a video at the beginning of this year and said, I underperformed the S&P 500. So far, I haven't been able to, but last year was a cleaning out of my portfolio, getting rid of some losers that I bought when I first started investing and didn't really know much. But now I think I have a very solid portfolio, you'll see here in a second, that I think has a strong chance of outperforming the S&P 500. But investing in an ETF, it also means that you are not investing massive amounts of time following all your individual stocks and having to analyze them and ensure that they remain a part of your strategy, your investing strategy. And time is money, it's precious, and you get to take that all back when you invest just in ETFs, because if you invest in individual companies, there's a lot of time commitment. You have to keep up with them, especially some people hold over 100 individual companies. I don't know how you can possibly do that. I like to keep about 10 stocks in my portfolio. That's about as much as I can handle. So let the funds do all the work for you. There's nothing wrong with that. You're still going to outperform most investors out there. Now, some do enjoy picking individual stocks like myself, and that's okay too. And if that's your thing, that's great. If you have that kind of attraction towards it, where you're going to put the time in, just like if you play sports, right? That's something that interests you, you're passionate about it, and you're going to put the work in. I think that's for you. But if it's not, and you're just in it to make long-term wealth, ETFs are an excellent way to go. Don't let anybody tell you otherwise. Now, my needle in the haystack stocks are in this portfolio right here. This is my portfolio. I'm up 36.68%. And my stocks that I think are going to outperform the S&P 500, maybe short term, but for sure long term, are Microsoft. I'm up 74% already. This is a beast of a company. They have a higher credit rating than the US government, the only company to do so. In fact, I think Johnson & Johnson is also, but I think they're at risk of losing theirs eventually. Then you have Amazon. This is another beast of a company I think will outperform. This company has amazing advertising revenue growth, and they're into AI. They're also in the cloud. They have the number one cloud platform, AWS. This company is going to keep on growing. In fact, it has over 100 companies it owns. It's pretty crazy, but it's very successful. What it does is the key. Then you have ASML. They have a wide moat. They're a monopoly. They're the only ones that really provide the technology with their lithography machines, and that is important to me. That's why I bought in this company. Then Health Equity is another one that I have been really promoting. No one else is talking about it out there, at least that I know of, But this company that provides health savings accounts and collects their revenue through fees, it's a beautiful thing. And health savings accounts, I think, are growing in popularity. I think this is one company that's going to do excellent, and it's already outperforming. In less than a year, because I haven't hit that 1 year mark since I bought this company, it's up 46.42%. That is amazing. Then S&P Global is another one that I think is amazing that's going to outperform. Data is gold, and they are a data powerhouse. They also are investing in AI too and what they provide. They're also in the indices business. They own the Dow Jones, S&P 500. So it's kind of like an ETF in itself, and it's going to perform similarly to SCHG up there on the right. That's my S&P 500 ETF, but it should outperform, being that it's an individual company that has more control over its profits, its revenue, so on and so forth. And then the companies that I think are just solid, more like ETF plays, are Union Pacific, because they have a wide moat, being one of the railroad companies, and Vici, being a high-quality REIT. I think this one has the potential to outperform. REITs, unfortunately, are dictated by the interest rate environment, but Vici has something special going on. They're invested in experiential properties like those casinos and entertainment venues on the Vegas Strip. They're also starting to expand globally, so I think there's a lot in store for Vici. I'm very excited. And then the ETFs, again, I have a dividend ETF, SCHG, to capture some dividends that I can reinvest back into this portfolio. And then SCHG is my S&P 500 ETF that I think is a really good ETF that should also provide me solid performance and outperform a lot of those that just do individual investing. So join this channel to see how I do versus S&P 500, and overall, just in general, I've been very successful so far, and I credit that to this quality checklist. This is how I find my needle in the haystack stocks. I look for those companies that have strong financials, effective management team, positive brand recognition, essential products and services, a wide moat, and a good valuation. Now, the only one on here that I might buy a company that it doesn't check is a good valuation. Sometimes it's okay to buy a company that's a higher valuation if it's a high quality company that meets all the other aspects on this quality checklist of mine. So you can feel free to take this, but just know there's a lot that goes into each category here that I talk about regularly. So that's another reason to follow, so you can start learning, because if you're invested in individual companies, then this is a great channel, and there's many others out there as well that will help teach you about investing. But if you're just holding ETFs, it's still good to gain knowledge. And so this is also a channel for you. Now, lastly, I just want to talk about Nikola, the EV company that just filed for bankruptcy. This company has been through fraud, and they've lost investors a lot of money. You will see here with their stock chart, over the last 5 years, they are down almost as much as you can go by 99.85%. If you look there, their stock price right now is at 47 cents a share. And at one point, they were almost $2,000 per share. So investors have lost big on this company. And again, they're filing for bankruptcy, and management estimated that the company has between $500 million to $1 billion in assets versus $1 billion to $10 billion in liabilities. Not a great situation to be in. Now, they once had a higher market cap than Ford, but due to a fraudulent video that they put out where they showed a semi-truck driving down a hill to show like, hey, we figured out this technology, we're doing it. Turned out the video was just the semi-truck. The angle of the video kind of changed it where it didn't look like it was downhill, but it's flat. But really, the semi-truck was going downhill. So it was just gravity pushing it downhill. It really wasn't driving at all. And so the founder, Trevor Milton, was convicted of fraud related to statements he made about that vehicle's development and the promises he made, as well as the company's supposed battery business. All were fraudulent. So the shares have plummeted, and this company before this has been desperate to keep that stock price above $1 to stay on the NASDAQ. So they've done some massive reverse stock splits, and it's just nothing's worked out for this company. And they joined other EV companies like Fisker, Cano, and Lordstown Motors that filed for bankruptcy in the last 5 years and went out of business. So I just want to say, with this piece of information, it's so important when there's a new exciting segment or sector of the investing economy like AI or virtual reality or EVs. Like, there's a lot of stuff that has come investors' way where investors get excited. It pumps up these stocks, but not every company is going to survive. And that's an important thing to remember. And so your due diligence by avoiding that is finding quality companies, doing your research, and having some patience, because I lost money in Tattooed Chef. I have talked about that many times. The whole, plant food based, I'm not even vegan or vegetarian. I'm actually a big meat eater, but I thought, I'm just going to listen to this guy and it's going to grow. And I lost money, not a lot, luckily, but still, the point being, do your due diligence, do your research. And so be smart out there and let me know what you think of VOO becoming the largest ETF. And do you hold VOO or SPY or different S&P 500 fund like mine, SCHG? And is that all you do, just ETFs, or do you invest in individual companies? I'd like to hear your strategy and how your performance has been. How successful have you been? Because I think being honest is key. That's how we all learn here. That's how we're all going to become wealthy on this channel. And I underperformed the market last year, the S&P 500, but I sold some losers. I now think I'm on a solid track to outperform, or maybe even at least meet the S&P 500's performance over the next couple years. But I am going to bet on outperforming because I'm competitive and that's what I want to do. So thank you for joining today. Happy investing, and we'll see you next time on Mark Arnold's Finance.